Now, it's nice to have you with us this morning. And once again, we are knee-deep in earnings stories. We were mentioning earlier that we've got lots of companies reporting on both sides of the border. And for some more perspective on what the takeaways so far during earnings season mean for investors, we're joined here in studio by Lesley Marks. She's Chief Investment Officer at Mackenzie Investments. Nice to see you.
Good to see you, John.
Every company has its own story and its own set of issues. But as you've been watching these earnings stories roll in, are there any takeaways so far for you during earnings season?
Well, I think there's two takeaways. The first one I would start with is overall earnings have come in pretty well. I mean, yes, there have been some idiosyncratic areas where we've seen weakness, but in aggregate, when you look at, and we're much further through the earnings reporting season in the U.S. with, I think, well, over 400 of the 500 S&P 500 companies have reported, and generally earnings have beat in aggregate. In Canada, we're just starting here earnings season, and as you're seeing a flurry every day of earnings. So the first thing I would take away is things are as good or better than expected overall when it comes to earnings. The second takeaway, what I'm trying to connect the dots is any indication on the economy, because obviously we're in this time where we're getting very mixed economic data. And I would say that, certainly more about the U.S. And in Canada, the economic data is generally on the weaker side and fairly consistently so. So when I look at some of the data points that we've seen out of some of the consumer-driven companies, which, as I think most of our listeners know, consumer is an extremely important part of the economy, makes up about 70% of the U.S. economy and 55 to 60% here in Canada. So this is a very important area for us to focus on. What we are seeing is that the consumer is starting to buckle under higher inflation, interest rate costs, which we would expect. It's just in the United States, it's certainly taken longer than we thought. And I think that seeing, for example, McDonald's earnings last week, where they talked about their customers trading down from eating out into going to the grocery store, for example. I mean, that gives you a really good lens into the lower income consumer. Then on the other extreme, you see Starbucks also seemingly impacted with negative same store sales. I think you're starting to see a bit of pushback from a higher end consumer that says, hey, I don't necessarily need that $7 latte. And that's starting to come through. So really important data on the consumer side from earnings reports.
And we just mentioned in the newscast, we had, in Canada, you have Pet Value. They, obviously a huge pandemic winner, but
Sure.
It looked like some of the sales momentum might have cooled off a little bit there.
And I think to be expected, when you have sort of outsized gains, remember how same-store sales work is it takes your current stable of stores and compares apples to apples. So what is that population of stores doing versus last year? And it's certainly, had sort of outsized growth in the pandemic years. So we're just seeing a normalization in that growth now in stores like, or companies like Pet Value.
The earnings stories are coming at a time when the market, especially in the U.S., did another U-turn on its expectations around interest rates for 2024. And I think a lot of that was dictated by comments we got midweek last week from the Fed Chair Jay Powell, who seemed to indicate that, for those who thought the next move by the Fed would be higher interest rates, don't expect that. But then, along with some of these signs maybe of a stretched consumer that you're referencing, we did see a weaker than expected jobs report in the United States on Friday.
Yes. So this is actually really interesting because it's been incredible to see how yields have come down so quickly based on the one data point of the jobs report. But here's the double click that I'm looking at from that jobs report. The last inflation number that we saw, where we were seeing the most inflation stickiness, was in the services sector. And as opposed to, say, cost of goods sold or goods, where we were seeing that more in the pandemic, coming out of the pandemic because of supply crunch. Services inflation was very strong because of the continued interest in travel, leisure, hospitality. So this is why the employment number was so interesting, because it was the services jobs that really declined, job creation in services. So that shows us that things and demand is really moderating in the services sector, which will find its way into the inflation number. And so I think that's why the market took that as a bigger sign than it probably should have, that there might be a change in thinking or the calculus or estimation for how many interest rate cuts we are going to see this year.